Are young people's economic futures really screwed beyond all hope? This is a common question that I've been asked by people who I know in real life and by the commenters in this channel. And in today's episode of Analyzing Finance with Nick, I'm going to react to Scott Galloway's recent TED Talk called How is the U.S. is Destroying Young People's Future? And Scott Galloway, even though I may not agree with him on everything, especially in terms of politics, provides a lot of interesting perspectives in terms of business and economics and how they intersect with culture. And for that reason, I'd like to hear what he has to say about the problems with the youth in America today. And without further ado, let's get started.
Okay. I start us with a question. Do we love our children? Sounds like an illegitimate question, right? Well, I'm going to try and convince you otherwise. Essentially, as we go down generations, we're seeing that for the last 2 generations, people are making less money on an inflation-adjusted basis.
That is correct. Gen Z and millennials are likely to be the first 2 generations in American history to have lower inflation-adjusted earnings over their careers and living standards than their parents. And this is a real big problem. And the main cause of this is, as you see here, is due to the increased cost of education and house prices relative to income, where due to a lot of boomers voting in policies both on the federal, state, and local government levels to restrict the supply of housing and turn what is supposed to be a shelter into an investment vehicle. And also you have a lot of policies designed to, such as student loans, which I talked about in a video series of mine, and the government guarantee of them, that artificially increase the cost of a post-secondary education.
In addition, the cost of buying a home, the cost of pursuing education continues to skyrocket. So the purchasing power, the prosperity is inversely correlated to age. Simply put, as we get younger, we're taking away opportunity and prosperity from our youngest. The social contract that is now no longer in place, and for the first time in the U.S.'s history, a 30-year-old is no longer doing as well as his or her parents were at 30.
Yeah, I mean, this is unequivocally clear. Most people whose parents in their early 30s were able to afford getting married and buying a house and a lot of other, having kids, which is out of reach for a lot of younger people today. And I just look at it, for example, with my own father. Like, his salary in late 1970s out of college, his first and second year out of school in today's dollars, just for inflation, would have been 6 figures, whereas my first salary out of college was around $50,000, and that was during the GFC. And yeah, it's a little bit higher today, like 60 to 80,000. But 60 to 80,000 is probably less than what 50,000 was when I graduated from college, and less than what 20 to 30,000 was in the 70s and the 80s. So this is unequivocally true. And I think it's honestly the sign of a broken social contract and an unhealthy economy, or one that's designed to protect the interests of the boomers, who are the oldest and the most populous generation, at the expense of everybody else.
This is a breakdown of the fundamental agreement we have with any society, and it creates rage and shame. As a result, people over the age of 55 feel pretty good about America, but less than 1 in 5 people under the age of 34 feel very good about America. Yeah. This creates an incendiary. Righteous movements, cuts to our society, end up becoming opportunistic infections, because generally speaking, young people have a warranted envy, they're pissed off, and they're angry that they don't enjoy the same spoils and prosperity that were provided to our generation.
I think he's absolutely correct about this. A lot of the recent protests in universities about the causes that they are taking on are kind of just misplaced energy. there's a lot of anger and frustration mainly on lower living standards for younger generations, but they don't realize what the cause of that is, and so they lash out in unproductive ways. And yeah, like that's rightfully so. If you have a social contract of most societies in the world, free or unfree, is really inherently based on that your children's standard of living is supposed to be higher than your own. And modern America and Europe are breaking this. And young people, I think, have a right to be angry about it.
A decent proxy for how much we value youth labor is minimum wage, and we've kept it purposely pretty low. If it had just kept basic productivity, it'd be about $23 a share, but we've decided to purposely keep.
Well, it means $23 an hour, not share, but not to be pedantic. But the thing that's more important is I disagree with him on minimum wage. Minimum wage only has to be legislated if you have an excess supply of labor relative to the demand for jobs. And yeah, maybe due to immigration policies in America, we do have historically an excess supply of labor relative to demand. But if the thing is that even before recent minimum wage increases, you saw wages grow during the pandemic due to shortages of labor supply. And that will create the equilibrium. All you're doing by raising the minimum wage is restricting opportunities to younger or less experienced people who otherwise would have jobs. Minimum wage jobs are not really intended to make a living on. And the reason why wages can stay so low is because you can find a lot of cheap sources of labor relative to just the overall demand of the economy. If you shrink the labor supply, minimum wage is gone. For most of Germany's history, they did not have a minimum wage. They enacted their minimum wage just fairly recently, and I don't think the poverty rate was exponentially higher in Germany than in other countries in the OECD. So I don't really see why you would have the same issue. I think the bigger issue with this chart is showing that the average laborer is not as productive as the average level of productivity. A lot of the productivity in our economy is skewed towards superstar producers, whether it's the master coder in tech or the better performing traders in finance. And the winner-take-all nature of the internet has created a productivity gap. And then there's also a lot of jobs in our society that are not designed for being productive, but to create a social class. And that excess grift is also explains this gap in productivity. So there's other reasons for this. Like, I don't think minimum wage would solve this problem anyway. We'll move on to the next part.
Out of reach, median home price has skyrocketed relative to median household income. As a result, pre-pandemic, the average mortgage payment was $1,100. It's now $2,300 because of an acceleration in interest rates and the fact that the average home has gone from $290,000 to $420,000. By the way, the most
this is a problem too. Interest rates were just too low back in the 2010s, which kind of skewed the data. But also, you've had structural lack of supply growth, and then you kept demand growth continuing through just natural population growth and immigration, so that you have way too many people moving into a relatively fixed supply of housing, and the places that need the most housing growth are the urban areas that are the job centers of the most restrictions oftentimes to construction. So that explains that, and that's directly a generational policy decision. So Scott is right about that. We're going to move on to see what he has to say more.
Expensive homes in the world, based on this metric, are number 3, Vancouver. Why? Because 60% of the cost of building a home goes to permits. Because guess what? The incumbents that own assets have weaponized government to make it very difficult for new entrants to ever get their own assets, thereby elevating their own net worth. This is the transfer I'm going to be speaking about.
The permitting problem is an issue in the U.S. too. Even in relatively business-friendly cities in America, you could have permit costs be anywhere from $150,000 to $200,000 just to start, and that's before a lot of other pre-construction costs, which could easily add up into the mid-six figures. And for houses that cost on average, say, $1 million, and you have 10 to 20% of the costs being permitting, that explains a lot of why construction is not profitable, and as a result, less people want to take the risk to do it. Or prices have to go up at a point that it makes sense to develop it. Yeah, I agree with Scott. Permitting is a major issue.
Where people over the age of 70 used to control 19% of household income versus people under the age of 40 used to control 12, their wealth has been cut in half. This isn't by accident, it's purposeful. This is me at UCLA in 1987. I know you're...
Yeah, I mean, you could see this also in the real estate numbers. It's like as high as 2/3 of all real estate in America is owned by people above 55 years old, and half of it is owned by people over 65 years old. And that kind of explains the main gap in household wealth. And then with the share of public equity, it's the same, because it's hard to save for a stock portfolio if you still have to struggle with increasing rents and aren't able to buy a house, or you had to spend a lot larger of a chunk of your after-tax income on that down payment in the first place if you did buy a house.
When I applied to UCLA, the admissions rate was 76%. Today it's 9%. I received a 2.23 GPA from UCLA. I learned nothing but how to make bombs out of household items in every line from Planet of the Apes. And the greatest public school in the world, Berkeley, decided to let me in with a 2.27 GPA.
That's nuts. I mean, I couldn't get into Berkeley with pretty much a 4.0 GPA in high school. And I have family members who had literally had to be valedictorians at a very competitive high school to get into places like Berkeley and UCLA. That's just like one of the examples. And the reason why is, again, you have natural growth in population and a society's greater value of education, but class sizes not going up proportionately. If we grew Berkeley and UCLA or other prestigious universities at the same pace as the population of the student body as a whole in the country, then you would have a lot more access. And no, do I think we should go back to letting in people with 2.2 GPAs into UCLA? No. But if you have, say, like a 3.5 GPA and a top 10 to 25% SAT score, yeah, that should be enough to get into one of the top schools if you're an in-state student for a school like Michigan or Virginia, North Carolina, UCLA, USC. And for the Ivy Leagues, yeah, it shouldn't be single-digit acceptance rates. Like, you look at schools like Oxford and Cambridge over in the UK, they have selection rates, acceptance rates of the 20 to 25% range, assuming you meet minimum qualifications. I think the same thing too. We reject a lot of young students with perfect SAT scores and perfect grades and extracurriculars. Those people should be able to get into Ivy League schools. If you just have like a minimum qualification, say you got to be in the top 5% of SAT scores and have at least a 4.0 GPA, and set that as your standard, the acceptance rates would be much higher, but it would be and it would still have the best and the brightest going to these elite schools, but it would be more accessible, particularly to the middle classes and the lower middle classes who do not have legacy advantages or the funds to make their resumes look artificially more special than they would otherwise.
And that's what higher ed is about. Higher ed is about taking unremarkable kids and giving them a shot at being remarkable.
I think it's not necessarily unremarkable kids. I mean, there are lower universities that could help with that, but I think it's to allow, say, like talented people who otherwise would not have a chance to move up the social ladder, you give them that opportunity. So, and yeah, Scott's right about that. That's what the university system is. It's supposed to help social mobility for those who are born in lower socioeconomic statuses, not just be a finishing school for the elites or be impossible to get into, that you have to be literally a super genius to even have a shot at a lot of these places.
And every year it's gotten more expensive. Higher ed and homes, and the ability, not only is higher ed incredibly expensive, it's not accessible, because me and my colleagues are drunk on luxury, and I'll come back to that. We've embraced the ultimate strategy. Me and my colleagues in higher ed wake up every morning and ask ourselves the same question when we look in the mirror. How can I increase my compensation while reducing my accountability? And we have...
That's basically any kind of bureaucratic clerical job where your salary is not based on P&L or performance or sales figures or things like that. And the way universities are doing that is that they restrict supply and raise prices, and then thanks to the fact that we have governments guaranteeing a student loan no matter what you study or no matter the probability of repayment, you have a lot more money available, so schools can raise their price to the maximum amount that the student loan lenders are willing to give to students, and that's driving this. I did a whole series about this several years ago on this channel about the economic forces that are driving up education, and that is by far the biggest one.
Have found the ultimate strategy. It's called an LVMH strategy, where we artificially constrain supply to create aspiration and scarcity such that we can raise tuition faster than inflation. And old people and wealthy people have done the same thing with housing. All of a sudden, once you own a home, you become very concerned with traffic, and you make sure that there's no new housing permits.
Yeah, he perfectly explains that. NIMBYism and restricting class sizes in the university is essentially a redistribution scheme away from the young and to the old, and away from the emerging money and those trying to break into the current system to protect the entrenched protected classes and the incumbents in society.
Harvard is the best example of this. They've increased their endowment in the last 4 years and have decided to expand their enrollment, their freshman class, by 4%. Any university that doesn't grow their freshman class faster than population, that has over $1 billion in endowment, should lose their tax-free status because they're no longer in higher education. They're a hedge fund offering classes.
Well, he's correct about that too. I mean, just on the returns on the endowment for schools like Harvard and Yale and Stanford, they could pay the tuition of their entire student body. They make way more money on the returns on their endowment than they do from collecting tuition and other academic activities. And you could argue that the money in some of these big sports powerhouse schools from TV deals and donations also probably exceeds the revenue from just tuition. I mean, it depends on the school. And the athletic donations are not necessarily all published, so it makes it a little complicated. But there's a lot of these schools have other businesses, whether it's endowment, fund management, or athletic departments, that actually generate more revenue than the academic side of the institution. And then on top of that, they have to pay all these administrators who make six-figure salaries just to manage academic department bureaucracies, and their growth has been way higher than the hiring of actual professors and instructors. So you have that problem also going. So it seems like a lot of the universities have departed from their main core goal of educating and providing economic opportunities and connections to their students at the expense of enriching the administration of the universities in other ways.
My first recommendation, Biden should take some of that $750 billion earmarked to bail out the 1/3 of people that got to go to college on the backs of the 2/3 that didn't, and give $1 billion to our 500 greatest public institutions, size adjusted, in exchange for three things. One, they use technology and scale to reduce tuition by 2% a year, expand enrollments by 6% a year, and increase the number of vocational certifications and non-traditional four-year degrees by 20%. Where does that get us? In just 10 years, that doubles the freshman seats and cuts the cost in half. This isn't radical. This is called college in the 80s and 90s.
Oh yeah, I agree with that solution. That would work. But I think the other thing you need to do is you need to cut off the source of the ability for students to overpay, and that is getting rid of the government guarantee of student loans. If you don't have the government guarantee of student loans, then students wouldn't be able to bid up college. Like, it would have to be affordable enough for people to can pay for it while having another job or working summers, or more modest savings of parents, like it was back when my parents went to college in the 70s. That's not really the case anymore, except for maybe a few state schools.
Another transfer of wealth. Look at what's happened to wages. Oh, they've gone up, not as much as corporate profits. There's a healthy tension between capital and labor. For the last 40 years, capital has been kicking the shit out of labor. Well, you think, whoa, what about wages, right? They've gone up. Well, if you compare them to the S&P, they barely register. It's been an amazing time to own assets, but your attempt to get the certification or the income certification.
Yeah, but there's no reason why the wages should catch up with the S&P 500 necessarily. Or profits. Like, there are a lot of reasons why companies are a lot more profitable today. That's due to leveraging technology to become more efficient. It's using a more international labor pool to lower labor costs, and just other benefits of globalization of trade that have brought down costs. And the S&P, in theory, should move up at the rate of nominal GDP and earnings growth. It has kind of got ahead of itself right now in the current cycle, but on a cyclically adjusted basis, that's what it should be. And should wages consistently go up at the rate of nominal GDP? No, because a lot of nominal GDP growth is population growth. So per capita GDP growth is not necessarily the same as absolute GDP growth because of population growing. Should wages go up at the rate of TFP? Yeah. The S&P is growing at a rate of nominal GDP is what the long-term sustainable rate of growth of the stock market is, whereas the long-term sustainable growth of wages is GDP per capita, or real GDP subtracted by population growth, and that is a much lower number. So that explains a lot of the dynamics. So yeah, I don't think that necessarily is all just a boomer redistribution scheme. However, the one part he does have correct is that you've had, until very recently, is that you've structurally had interest rates go down and have loose monetary policy to support the stock market. And that's what has driven a lot of the valuations, say, from the 1980s to the 2010s. And also switching away from defined benefit pension plans to 401ks, which had a lot more money outflowing into index funds, which also explained the big boom in the S&P 500. Neither of those things really are purely a boomer retribution policy driven. Like, there are cyclical reasons that the Fed needed to raise and lower interest rates, but the fact that it structurally had 35 straight years of falling rates, and you had the 2010s, you had over a decade basically of interest rates staying well below inflation, was to protect asset prices, I think, for the boomers who needed to retire. So that is where he makes a good point here.
I'm not against Social Security, but the criteria should be if you need it, not whether you have a catheter. 80% of you have absolutely no reason to ever take Social Security. It is bankrupting our nation, and we have fallen under this mythology that somehow it's this great social program.
Medicare is the one that is more likely to bankrupt the nation. Social Security is unsustainable. It's based on a demographic pyramid that no longer exists. Means testing it alone is not going to solve that problem. especially given our political climate, if you restrict means testing to those who make more than $400,000 a year, I don't think it will even make a dent in the insolvency of Social Security.
The great intergenerational theft took place under the auspices of a virus. I know, let's use the greatest health crisis in the century to really speedball the transfer. This is the NASDAQ from 2008 to 2012. We let the markets crash. And by the way, you need churn, you need disruption, because it seeds and recalibrates advantage and wealth from the incumbents to the entrants. It's a natural part of the cycle. But wait, lately, no, 1 million people dying would be bad, but what would be tragic is if we let the NASDAQ go down and guys like me lost wealth. So we pumped the economy, which again increased the massive transfer of wealth. The best 2 years of my life.
Yeah, but they did this also from 2013 to 2016 through various QE measures and other central bank interventions to hold up asset prices. I used to joke with my coworkers on the trading desks that, like, oh, the boomers aren't allowed to have their stocks go down, so the central bank will do anything to protect them and suppress volatility. And that kind of cynical sentiment really took its extreme levels during the reaction to the pandemic.
COVID, more time with my kids, more time with Netflix, and my value of my stocks absolutely exploded. And who has to pay for my prosperity? Not me. Future generations who will have to deal with an unprecedented level of debt.
Well, I mean, I don't think I'm not too concerned about the debt, and I might talk about this in a future video, but really the reason why I'm not concerned with the debt is not necessarily it's sunshine and rainbows. It's because our politicians, through years of artificially low monetary policy and no willingness to have any sort of fiscal austerity, have kind of sealed the deal of using inflation as the solution. If you have a more realistic rate of inflation based on private sector data than what the government publishes, we've already inflated about 30 to 40%, depending on what numbers you use, of the debt, including all the COVID stimulus, just due to a higher price level. And so, you know what? You're paying for it through your rent bills going up 30 to 40% the last 3 years. You're paying for it through all the excruciatingly high grocery prices and car insurance prices and this general increase in the price level. Yeah, that's how we're paying back our debt. And if the 70s is an analog for this, we're probably almost halfway through the repayment process. But yeah, we're paying for it through higher inflation. So it's not the debt that I'm concerned about. It's the negative social reaction and the social contract falling apart due to our policymakers using inflation as the solution to paying off our debts.
Why am I here and why do I get the prosperity I enjoy? Because in 2008 we bailed out the banks, but we didn't bail out the economy. We let the markets fall. So as I was coming into my prime income earning years, I got to buy, no joke, these stocks at these prices. This is where those stocks are now. Where does a young person find disruption? When you bail out the baby boomer owner of a restaurant, all you're doing is...
Kind of explains financial nihilism and why people think crypto is the last gasp. I think that's a little bit false, but yeah, you can see the logic of the financial nihilism. I did a video about that, which I recommend checking out, because they think, look, I missed the chance of investing in the blue chip tech stocks at reasonable valuations, or any other in the stocks at reasonable valuations. The one that are not trading at rich premiums are the companies that are slowly dying. And I can't buy a house at a reasonable price income ratio either because of money printing. And so therefore I just have to gamble to catch up. And that's what people are falsely doing as a solution to this problem. But he's right, yeah. I mean, the investment opportunity pool on the aggregate is not as favorable as it was during the depths of the GFC, but most economies outside of recessions, you don't get those kind of opportunities either. Nonetheless, valuations are historically high given the yields you can get in the bond market right now, and also relative to economic growth prospects. In the rest of this video, he goes into the Great Social Depression, which I've also coincidentally done a video about, where the social media algorithms on platforms such as Instagram, Facebook, and TikTok are messing with the attention spans and the self-worth of young people, and is making them less productive and less motivated. And with the economic variables that Scott mentioned earlier pushing against them, it's making a bad enough problem a worse problem, and creating a lot of learned helplessness when there really is a lot of opportunities still in the world due to the internet democratizing access to valuable contacts, and also making distribution of any new product or service digitally way more affordable than you had to do those ways in the physical world in the past. Yeah, towards the end of his presentation, Scott goes into the solutions. Like, yeah, great, you're going to do a good job mentioning the problems, but what are some of the policy solutions that he advocates? And this is probably where him and I disagree the most. Some of the things you see in the PowerPoint deck is he wants to increase the minimum wage to $25 an hour. I don't think the minimum wage should be really increased at all. AMT for high income and corporations. I think the main flaw of AMT in the past was that it was never indexed to inflation, so middle income people got caught up, and then like, what is your definition? Like, upper middle class people or making just enough could be comfortable to raise a family in these cities count as high income, and now they're going to have to pay AMT, and then the pass-through thing of corporate taxes. He has to basically reform Social Security, means test it. I don't really think that's going to make a dent in fixing Social Security. If you really want to fix Social Security, they're going to have to raise taxes materially, or you're going to just have to have families be more willing to help each other out, particularly younger generations with their parents, or you just need to have a cultural shift that prioritizes actually saving for retirement rather than just spending on enjoying life now. But yeah, Social Security does need to be reformed. I think you should allow the option to opt out. But I don't, Scott wants solution is not going to really solve the problem, and is really just more of a hedge to contain envy in society.
Social Security, it should be based on whether you need the money, not on how old you are. We need a negative income tax. My friend Andrew Yang screwed up a great idea, but he branded it incorrectly. Instead of calling it UBI, he should have got Republicans on board by calling it a negative income tax.
UBI, I think, is flawed because, one, if you just give people the power to vote their salaries, that's going to lead to a lot of political problems. And I think there's too large of a chunk of the population, as you see in my commentary on anti-work, that would just take the deal if it's high enough and just opt out of the system, which would have the negative effect of lowering the supply of goods and services in the economy while maintaining the same amount of demand, and that would be inflationary, so which would therefore demand even greater increase in basic income. And just the moral precedent that sets that you can just get by and just by watching this channel all day is not really a one you want to set for to have a successful country that continues to grow. That's more of like you're collectively saying we've decided to retire as a society, and countries that have kind of done that, such as France, have been in structural decline.
We need to eliminate the capital gains tax deduction. When did we decide that the money that capital earns is more noble than the money that sweat earns? Shouldn't it be flipped?
It's nothing about nobility. It's the fact that you want to encourage longer-term investing versus just day trading or short-term financial decisions, and because that's how you grow and build companies, by having long-term committed capital. And second, the reason also why you have a lower capital gains rate tax to compensate for inflation, because a lot of the returns over a long period of time are simply just inflation. And should people be taxed just because their investments have caught up with purchasing power, so in real terms have broken even? I don't think that's very fair. So those are the main two arguments I would say that you want to keep a lower capital gains tax rate. If anything, if you want to get rid of the capital gains tax exemption, just lower ordinary income taxes to the same level as capital gains, or find some level in between to have them both at, versus just raising capital gains to a relatively high ordinary income tax rate. Overall, I think Scott has some interesting arguments. He's good at pointing out the problem, but I think a lot of his solutions are incorrect. I don't think blunt instruments such as raising the minimum wage are going to fix things. You can't fix this by increasing purchasing power and demand through government fiat. The solution to a supply and demand problem where supply is structurally low is not to raise demand to make things affordable. It's the opposite. It's to find ways to increase supply. It's supply-side solutions. And I don't mean that in the Reagan-esque supply-side economics type of way. I mean that in the way that you literally have to reduce the barriers that restrict increasing supply in the most regulated industries such as healthcare, education, and housing. That's how you would solve these problems, is just getting those costs down without causing a bunch of inflation by artificially increasing demand or using government stimulus or other minimum wage increases or other blunt measures that don't directly address the problems.